Morning, everyone. I assume you can all hear me. Sort of opted without the mic. So my name is Steve Torsa. I'm the founder of Wholesale Investor. Just out of curiosity, who's come across me before? Okay, so half in, half out. All right, so as a first step, just to help me get a sort of sense of where everyone's at sort of with their business, I assume you're all founders? All founders? Okay, perfect. And who's sort of first time raising money, out of curiosity? Okay, half of you. Second time raising money? Third, fourth, fifth, 5+? Okay, no one's at the 5+ yet. That's battled hard and anyone's gone through 5+ raises. So I'll just give a quick introduction to myself and then I'll sort of get into the presentation. So I launched Wholesale Investor actually this month it's 17 years ago. It actually only sounds bad when it comes out of my mouth. It doesn't feel like that when I sort of, when I'm actually in it, because we've sort of reinvented ourselves several times. When we sort of started, we had this initial idea about curating a marketplace of high net worths and family offices and then just providing them with access to curated deals. And so we started as a magazine, and then obviously 2012, we got rid of the magazine, and then we started basically doing online to offline, sort of events. And we'd do showcase events. We literally hosted one last night. You were at it. And then from there, we then sort of around 2014, we thought, well, we want to start doing things overseas. So we started taking Australian companies to Singapore, Hong Kong, UK, etc. 2018, my craziest year to date, almost as bad as this sort of lineup I'm giving myself in these 2 weeks. But basically we did 48 showcase events across 7 different countries in 1 year, right? And that was the point where I said, this is just ridiculous. So at that point I thought, I want to build software to actually understand the process. The other truth about it was that even though I'd been in the space for 10 years and I'd been promoting companies raising capital, I'd never actually focused on the actual process of raising money from start to finish. And it was at a time that I actually needed to, so I was fortunate in 2016, I had Investec become a shareholder in my company, going through that process of dealing with an investment bank, across a 12-month period to become a shareholder, one of the most eye-opening experiences that I've been through. But this next time I wanted to raise money, and I actually engaged a shareholder to assist me, and I thought, shareholders probably the best one to help. They're specialists at raising money. They've already raised money to invest into our business. And so at the start of the year, they sat down with me and said, look, what we're going to do is we'll raise your initial 1 million. And sorry, this was in about sort of March, April. We'll raise you 1 million. I thought, great. And then what we'll do is we'll then go raise you another 5 million. So you can really sort of, accelerate the business. I thought, perfect, sounds like a good plan to me. Who would like that plan for their business? Right? I thought it was a great idea from a shareholder, So basically we sign off, took a while back and forth on the terms, we sign off, and I thought, great, I don't need to think about my capital raising. Anyone else be in that position where you thought, okay, I've engaged someone to help me with my capital raise, I no longer have to think about it. Anyone had that? Okay. So around September, there was only 2 people, by the way, around September. So I didn't think too much about it. And then around September of that year, I sat there and thought, I've only had 2 conversations with investors from the advisor. And I thought, I'll check in, find out. So basically I said, yeah, no, all going well. And then what was even more concerning was I was dealing with a junior person now in the company. And I was like, this person doesn't know me from a bar of soap. He doesn't know my business. He's only got a very high level. He's not really the person that should be raising. So basically with the main person, I organized to have a catch up. And this was sort of in October. And he basically once again assured me, things were on track. Now in my mind, I was meant to already have 1 million raised and we'd be on track for 5 million at this stage because we were going to be raising 6 million by the end of the year. So basically another month goes and it's coming November. I'm in a B2B business. I know that who else is in a B2B business out of curiosity? Okay, what months do we hate the most? December, January, absolute cash hole. Those months suck, right? For anyone that's in B2B, it's a terrible time of year. So basically I called him again and I was starting to freak out. And basically, so by the end of November, here I am expecting that I would have had $6 million raised by now. How much do you think was raised? 100K. Slight gap, right? So I was under massive pressure. So basically I ended up having to put money in myself to basically survive that sort of November, December period. And it was pretty much at that time that I just made the decision to myself. I was like, beat that. I'm actually going to own this process myself. And I actually want to learn the process of raising money. And I was fortunate enough, I was surrounded by investment bankers, corporate finance guys, and all that sort of stuff. So I started asking everyone about their process for raising capital. Now, if you watch all startup media, all their focus is around what when it comes to raising money? Who wants to answer? What do they focus on? No. If people are teaching you about capital raising, what are they typically teaching you about? The pitch deck. Everything's Then I found out, so as I went through this process, the pitch deck plays the smallest possible role that you can imagine when it actually comes to raising money. But yet every single bit of content was focused around the pitch deck. So then I started focusing on what is the actual process. So this is the agenda for today. So I wanted to give that introduction so you understand where I'm coming from, because this was a story that led me to think I need to change about how I'm actually going to think about raising money. So these are things I'm going to be covering today from a conversation perspective. Few things, obviously, I'll go through a workshop. Now, this was initially 90 slides. Now, I figured I wasn't going to get through 90 slides in the space of 60 minutes. So it's cut down a bit, but I've got plenty of content online that can really help. This is the why that I actually did this, because number one, when you're going through a capital raising, it is the most emotional journey you'll go through, and it's a flat out roller coaster, right? And the thing is, no one likes to talk about it, because we all want to stand up every day. We walk into here, we go into see our teams, and we all want to look bulletproof. But the reality is we're going through this eternal sort of, emotional roller coaster. So ultimately then it started thinking about how to actually do things differently. Now, the fundamental story that everyone forgets about raising capital, again, who's raising their first round of capital, right? First or second, that's very early. This story, I think, is the most important one that everyone should remember when they're going through their first capital raise. And that is what it took Blackbird to actually raise this money. Now, this is not me getting any inside secrets. This is what was published in media about their own journey for raising their first round. Firstly, it took them nearly 2 years to get it done, right? They actually called it the 2012 fund. They finished at the end of 2023 to actually close it. It took them 500 meetings. Now, bear in mind, these guys were already successful and already had networks that they could tap into for their raise. They did 500 meetings. Now, if anyone's know what it takes to get a meeting with different investors, how many people do you think they reached out to get 500 meetings? Just basic numbers. Anywhere between 1,500 to 5,000, right? They would have reached out to a ton of people to get 500 meetings. Right? Now, what's really important is how many investors did they bring on? 97. So what was their conversion rate? 1 in 5, right? Now, in that, they raised $30 million. So what was their average check size? Right? 300K, right? Now, the reality is they probably have some really big investors that put in a lot, and they probably had a lot of investors that put in 25K, 50K, etc. Now, everyone that typically comes to me, I'll get a phone call into the office, say, "Hi, Steve, I'm raising money." I have a chat with them, say, "Now look, people are raising less now, but this is the sort of conversation we used to have was, I'm raising $5 million. I want to close in the next 2 months, and I want minimum check sizes of 500K. Right? Now, hear that laughter? That's how we get geared up to think what a capital raising is like. Because a lot of you may actually still think that that is possible. It's not, right? Unless you are banging out red hot numbers, right? That's in the top 0.1% of what startups do. That's a very difficult thing to achieve as far as 500K check sizes and raising that amount, right? So, and then all sorts of other options are open to you. But, I want to start that with that perspective about what it really takes to raise money. So the first one is how long do you actually think it takes to raise money? Right? This is the common belief. Anyone want to shout out? How long does it actually take to raise money? 6 months? Okay, who's raised money beforehand? Okay, perfect. For those that have got their hands up, how long did it take you to finish your capital raise from start to finish?
Look, it's varied. I've done something 3 weeks, I've done something 9 months.
Perfect. 3 weeks to 9 months?
Same sort of thing, but up to a year or more, where people are still saying we're going to pay the money out yet.
I've had that 3 times. Pardon? 18 months. Just to set the expectation, right? It's a really nice thing to really understand that it can take anywhere between that 3 to 12 months. 3 to 12 months if you absolutely nail it, but be pragmatic and think around that sort of 6 to 12 months because it will take time, right? But fewer than 5% of companies actually achieve that. Now, why do I say that? Because when I was raising money, that same shareholder that was going to raise me $6 million, when I asked them about how should I structure my capital raise, the way they said to me that I should do it is that what I should do is, because I had a whole bunch of interest in our raise, they said what you need to do is you need to set a close date within 2 weeks. I was like, okay. I thought that's a bit aggressive, but this is the advice they gave me, right? So they said 2 weeks. So I started telling investors, here's the raise, here's the terms, we're going to be closing in 2 weeks. What do you think the response I got was? Too soon, too soon, too soon, too soon, every call. I was like, well, beep, that didn't work, right? So when you do that, I felt like an absolute idiot because then I was telling everyone I was going to close in 2 weeks, but there was zero chance I was actually going to close in 2 weeks. So it ended up that, so basically that's the first thing is just be pragmatic in your timeframes, and I'll go through how to actually think about it. Now this is the last one. I'll mention this. Now, VCs have played an incredible role in the Australian ecosystem, right? Billions of dollars pummeled into companies, incredible success stories created. The reality is many of you are thinking about how can I raise from a VC? Just to set the reality, and this is from their numbers, not from mine, VCs will typically invest in 1 in 100, and the most I've ever heard from a VC is 1 in 1,000 companies, right? So just so you understand. And then what's even more than that, with those companies they invest into, the likely follow-on is anywhere between sort of 10% to 20% that they will follow on with their investments, right? So then you ask yourself, well, where does actually all the money come from to come into companies, right? So the reality is the majority of you will end up ultimately raising from angels, from high net worths, from family offices, from strategic investors, potentially CVCs, corporate investors, etc. But when I've watched all startup media come out, it is all focused around how to raise from a VC, which is great if you're a VC type business to be backed. Now, if you want to understand if you're a VC type business to be backed, it's really easy. Have a look at the VC that you're pitching, have a look at the fund size, and ask yourself the question, if they invest into me, can I potentially replace their entire fund with the value I create, with the value that gets created from my investment? Easiest way to think about it, because that's what they're after. They're after moonshots that can return the entire value of the fund, aka Canva, right? If you think about Canva, if you took that out, and this is the power law effect that VCs are going for, they're looking for that one company that can have such a fundamental difference in the value that gets created in their portfolio that makes a difference, right? But this is where, now of course we're all bullish and optimistic, right? But the pragmatic reality is they're looking at your business saying, can this replace my entire fund, right? Starting point. So that's why they're happy for companies to fail, because it's either going to be they're basically looking for rocket ships, but the reality is many of you can be a fantastic investable aeroplane, boat, car, etc. But ultimately they want to invest in rocket ships, right? But when you understand those metrics, it helps you understand where you are, right? Once again, this is a day in your life when you're actually going out to raising money. One day you want to give up, I'm going to hit the wall, I'm going to do this. It's just, I just cannot explain to you the emotional roller coaster ride. Just the reality is, I'll get out of the way. Every one of you experience it. The only reason why I talk about this, do you know I used to start my presentations, I used to do one slide and I used to start off the slide and I put down all the ways in which I got rejected. And the reason was I did that because I want you to let you know it's normal. It's 1,000% normal to go through it. No matter what bulletproof confidence you're going to be pitching the next day, It's completely normal to go through this. Now, typically when I meet an investor, they ask me the question, can you introduce me to the good deals? And I sit there and I think, well, every investor's got their own variation of what a good deal is, right? So then I try and really understand what do they mean by, what is their good deal? And typically where they ultimately land is they want to find out who a top VC is investing into faster than someone else, But then the reality is for a lot of the high net worth and family offices, a good deal means something very different for every single one of them because they've all got different backgrounds and experiences. So that leads to the next one of when companies ask me, can you introduce me to the good investors, right? Once again, every company has a right type of investor, right? Because they can add value, strategic input. They've got different things that they're actually focused on. The other thing, people try and make you feel like your business needs to be absolutely perfect for an investor to go into. That is also not accurate. There is plenty of companies that are going through hell, traumatic times, turmoil, that are still got capacity to raise money, right? Because this is the world they're dealing. If they want a perfect company, they can go put money into BHP, right? Or CBA. That's where they can go. That's not the land that we're actually in. So the other part is understanding a little bit about the investor psychology. One of the favorite things, and when I say favorite, I'm being sarcastic, one of the favorite things you're going to hear from an investor is, who else has invested into your company? Anyone heard that? Who's leading the round, right? It's one of the most frustrating questions to get asked as a founder, right? So investors fundamentally, they don't want to be the first one in, but they also don't want to miss out, right? So there's this game that's being played. Common mistakes that typically founders go through, and I'll just go through this really quickly, right? And basically this overconfidence part, because of course we have to go with confidence because we're selling our business, right? And understand that when you're capital raising, your business is a product in their minds as far as what they're going into. But these are typically all the different mistakes that people make when they go into Firstly, this one of, I don't have time to go on. I've literally had people say, we don't have time to do X, Y, Z when we're raising. They're literally just hoping to send out pitch decks and money comes back flying in. Who's been able to complete a raise just from sending out pitch decks? All right. If you watch any other presentation, you'll get the same response, right? The pitch deck plays such a small role ultimately in this process. So once again, if this is your first time raising, it is a lot harder than what you think. Now, it's a bit of a crude analogy, but the easiest way I like to explain what capital raising's like, right, for those that are starting out their journey, it's like, and by the way, I'm married, but so I'm using the example of dating. It's like online dating, right? It's like putting up your profile, sharing it with 100 people, and then 97 people coming back telling you why you're ugly, why they'll never date you, and then ghosting you. That's capital raising. Great fun, right? So here we go. So this is the expectation versus reality of what people think when they actually go into a capital raise, right? You have that what you're imagining is the money coming into the business, right? The reality is by the time you finish the capital raise, you almost feel like you're begging, right? As I said, there are standout examples. I'm just going for the, what 99% of people experience when they're typically raising. So what actually is capital raising? And it's a really good question to ask. And so and this was the most important thing for me that when I understood what it was more like, was it is effectively just a sales process, right? It is a marketing and sales exercise. And if you really think about it, that's what investment bankers do. That's what corporate finances do. Corporate finance people do. They literally build a pipeline of potential investors and then they run them through a sales process. That sales process they're running through is your company. Your company is the product which they're offering. So basically, in understanding what capital raise is, the first fundamental thing is just understand it's just simply a marketing and sales process. So the first four principles that I sort of learned with was, so first one is get ready. And the reason why that's the most important one was when Investec expressed interest in investing into us, I wasn't ready. They asked for a business plan, I didn't have one. They asked for a pitch deck, I didn't have one, right? So I went straight into mode of basically creating all this material. And I had to make them wait 2 months before they actually got it because I was also busy doing all sorts of other stuff. Terrible when I look back on, at that stage. The second part is once you get ready, stay ready. The reality is you never know what opportunities or challenges are around the corner with your business. So staying ready to raise money is important, right? And if you think that the process of raising money is you raise money in 2025 or 2026, and then great, I don't have to think about it for 2 years. Go and have a look at the way in which Canva has raised money. I can't remember what it was. How many rounds has Cliff been through? He actually said it on a podcast. It was something like 13 to 19 rounds. It was a stupid amount, right? Always going through that process. Sometimes they were raising to do secondaries, sometimes, and they even publicly have said that they were profitable, but yet still been raising, right? Life science CEOs, anyone in technical area, technical business? Okay, a few of you. Do you know when they hire listed company CEOs for technical businesses, they do it on the basis they're going to be spending anywhere between 40 to 60% of their time facing investors, right? That's the nature of a technical business. Next one, always be raising, right? Now, this doesn't mean that you're always trying to bring money into your company. It just means you're always having conversations with potential investors. It's a great rhythm to get into, where you're sort of at least 2-3 times a week having conversations with potential investors, right? And it may not even be you're asking for anything, but you're just having conversations about their view of the world, understanding what they're looking at, what they're seeing, sharing what you're doing, etc. So in investment banking, they have 2 types of roadshows. They have non-deal roadshows and they have deal roadshows. Non-deal roadshow is when they're just going out, basically sounding, the sort of feedback from investors. So they're going out presenting their business to investors. And then a deal roadshow is when they're actually raising money. The non-deal roadshow is to set up for the deal roadshow, right? So they take all that input, they take all that advice, they take that guidance, and then they go and then structure. And when you're actually raising, this is the best one. Get to a yes or no as fast as possible. Now, for those that have raised money before, what is the fastest yes that you've ever received? Anyone want to share? What's the fastest yes that you've ever received?
Well, one phone call because of the relationship.
Perfect, that's a good point. I'll get onto that. Anyone else? What's the fastest yes? A week? Perfect. Anyone else? Fastest yes? Do you want to share? 45 minutes? Perfect. Mine was 7 minutes. I thought we're going to be having a call to talk about the business. We wanted to have a call to talk about application forms. I thought, fantastic, right? Already done. Now, what's the longest time from the time you've met a potential investor to the time they actually invest into your company?
Still waiting.
Still waiting? Good answer.
5 weeks.
5 weeks? Geez, that's short. Anyone else? Mine, 13 years. Came to my launch party, participated 13 years later, right? You just never know. It's just such a wild journey, right? But get to the fastest. Now, so what that also means is a no today doesn't equal a no tomorrow, right? And it's a big mistake that companies make when they're raising money is they effectively don't basically follow up. When I did an interview with Jason Calcanis, who does the All In Pod, I asked him the question of, when companies pitch you guys, what percentage of companies actually follow up and give you updates on their business when you're not a shareholder? And do you know what he said? Low single digits, right? That is probably the biggest missed opportunity cost for every founder. So now, once again, it's a marketing and sales process. So to understand the marketing part, if you understand the simple principles of marketing, it's very straightforward. Marketing teaches you that basically the buying process of any product is, firstly, there's awareness, then there's consideration, and then there's a decision. Most people feel like capital raising is awareness to decision. They forget that entire consideration part, which is ultimately filled with a lot of engagement. And now, what you can utilize is things like, so there's another principle called mere exposure effect, where sort of in advertising they used to teach that, people need to see something, 7+ times to get comfortable with it. Because of social media, that's cranked up now to 15 to 20 times, right? So really understand that people do want to feel like they know more about you before they actually participate. Now, George mentioned an interesting thing. He said that he had an investor come on board after one phone call. So I learned this from a Singaporean investor, where he actually helped me understand basically the time and space relationship between who's in your network and the time that someone becomes an investor, right? Now, I said, I'm saying this all outside the context, assuming that you're all not doing 1,000% growth this year, and doing crazy numbers like OpenAI and all those guys are doing. I'm saying that on this assumption. So I'm not going to spend too much time on this just at the time, but you get the idea, right? The reason, what happens is people often raise, they call it the triple F round, friends, family. It used to be called fools, but you're going to be diplomatic and call it fans, right? The friends, family, and fans round, right? They often raise this. And that's because it's by typically people that are known to them, or there's been some sort of referral introduction where it's very, very trusted. Where they struggle is when they move outside of that and they go into the new contact area, right? So then they want to understand what are the different levers to actually get across a business. And so the only way to actually speed that up is to basically go from the process of unknown to known and then go through some of the capital raising elements. I've got different names, whether it be capital raising brand elements or investment highlights, it ultimately ends up being the same. So then what are those capital raising brand elements? And I'll cover that shortly. So effectively, the first role for you as a founder is to basically go from unknown to known, right? As much social media you do, as much awareness as you create, as many events you go to, networking, etc., you have to hustle hard to be known. Right? That's pretty much the first step. Whether it be you doing it just by sheer effort, whether you doing it paying to do it, however it is, you have to make sure that your business is known. And then the next stage is you have to engage people, right? You have to somehow get into their top of mind. So the problem that people don't know, and once again, I'll use this example, is when you do have someone that's interested, I love using this as an example, right? Because these are a perfect example of if you don't streamline the process to make it easy for investors, it's actually quite easy to lose the investor, right? And that's what you saw with the destruction of Blockbuster, and that's what you see with the destruction of taxis, where basically those industries were transformed because the process for engagement was streamlined. So the next part is the blunt reality, and I'll connect what I was going through beforehand. The blunt reality is that for that investor that you're speaking to, at the exact same time, they have anywhere between 15 to 30 other opportunities that they can invest into. So the question is why should they invest into you? Right? So understand what your competition is. Your competition is absolutely every other thing that an investor could invest into. Right? Now for a start, previously, if you go back sort of 10 years, it'd just be focused around what other startups could they be invested into. But of course, now there's other asset classes which are also rocketing up in value as well, right? So crypto is a perfect example. When you think about how much value is being created out of crypto, that's almost at what startup value investors want to create. You also see it in small caps, sometimes in listed companies. There's often a crossover between that type of investor. So the main thing you should be thinking is how can you actually have your capital raising working for you 24/7? Right? How can you set yourself up so it's always working for you, and that investor that you spoke to 3 months ago, that they've got access to information at the time that's relevant for them, right? So first part is, and I'm going to go through how an investor actually comes across an opportunity. Most of us get educated that basically the first stage for an investor is the pitch deck, right? Well, if you're at a networking function and you're going to introduce your business, one of the worst things that you should do is to download everything onto a potential investor. I had a really uncomfortable situation with a client we were working with, where basically, he was really struggling to get interest from investors. And so basically what most have, and it was a technical business, so it mostly starts with, there's a problem with your investors. I said, well, Ray, do me a favor. Tell me what you do. 15 minutes later, he was still going. Right? Now I said, Ray, I'm polite and I've listened to you for the last 15 minutes. If you're in a conversation with an investor, they checked out a long time ago, right? I said, you have to get down to what you do to a one-line hero text statement. No different to, when you go to someone's website, there's a hero text. You don't see an absolute blurb of information that lasts for 15 minutes to read on the first page, right? It always starts with a hero text. We're all being absolutely driven to consume information in this structure. First stage, hero text. So typically, and go play with your, whatever LLM you're using for this, go and play with this, right? Go and throw into it, go put in your whole website, put in your pitch deck, create for me a hero text targeted towards high net worth, family offices, venture capital investors that summarizes my business in 3 to 7 words, right? Get for yourself your hero text to start with. My hero text for my business actually come from a shareholder 5 minutes before I was about to go and give a presentation, right? So I literally quickly went and changed it. So the elevator pitch, keep it super simple, Do you know how? Identify what the problem is, right? What we do is identify your solution. Keep it as simple to that structure. Do you know how? Identify the problem. What we do is identify the solution, right? Because the way you also got to remember is our brain chunks things down into compartmentalization. Now, the next one is to go through the investment highlights and the capital raising brand elements, which I promised I would get to, and I think it's on the next slide or the one after. But effectively, these investment highlights are the things which basically hook the potential investor in. So in marketing, we're taught about AIDA, attention, interest, desire, action, right? So the first part you got to do is you got to get the attention. Second part, the elevator, is to get the interest, right? Desire comes from this next stage, which is the investment highlights and the capital raising brand elements. And then the fourth stage is them wanting to see your pitch deck. So for every article you're going to see about how to create the perfect pitch deck, I'm sitting here thinking about these elements first, right? Because they're the things which people are attuned to, right? When who's sent out hundreds of pitch decks? They basically just go into like a black hole, right? And it'd be interesting to see how many actually get read when you're just doing, do you know, on LinkedIn, people share pitch decks with me. I'm like, who's opening up PDFs on LinkedIn, right? For me, I don't. I just have random people send out that I've never met before, add me, I add them. First thing they send, long email and a pitch deck. When I'm on LinkedIn, you're getting seconds of headspace from me, right? Literally, because it's filled with all sorts of other crap as well. But anyway, all right. So I mentioned about capital, I've got different names for it, capital raising brand elements, investment highlights. When you think about investment highlights, you're always seeing, straight away your brain goes to the financials. Am I correct? What are you doing from a revenue? That's not actually what I'm talking about when I'm talking about investment highlights. How I learned this was, do yourself a favor, go and read every article that Yolanda Redrup writes for the AFR where she's talking about companies that have raised money. Go and have a look at the structure of those articles. Go and have a look at the component what she actually writes in it, right? Because she actually does it one of the best that I've seen. So effectively, when people are actually talking about it, what investment highlights in your case when you're raising money is social proof statements that are relevant to a potential investor. So first one is strength of your team. Does your team have been there, done that experience? Have they worked for the likes of brand name companies? Have they been through a successful exit before? Do you have advisors that have been to IPOs? What is the background experience? What is the name that they can cling on and go, oh, that's interesting? Have you ever noticed why whenever they do articles about founders raising, it's always like X Canva, X Google, X this, X that, etc. Because they're going for that social proof statement. This person used to work at Canva, it elevates their positioning to that level. Or this person has previously IPO'd XYZ company, it elevates them to that level. If you don't currently have that across the team, then the way you can supplement that is potentially with advisory board members, right? And for me, my first advisory board member was Tim Trumper, who at the time had just finished up as a senior role at PBL, right? Which is James Packer's company, right? So you're talking 16 years ago, right? 17 years ago. And now he's like chairman of, he was just finished as the chairman of NRMA, did Quantium. Like it's all those brand names that people sort of in our space would know. People are looking for names that they can cling on to go, oh, I know that person. What they're looking for is they're looking to get to a moment where they go, that's interesting. Why is that person involved? Why are they doing that? Next one is, what are the assets on your team, as mentioned, as far as, across the C-suite? Next one is existing investors. So often people want to talk about just the professional investors, so whether it be a VC firm or whatever that means. Even if you've got known high net worths or angels backing your deal, that's relevant. Once again, think about the articles you've seen where people have talked about raising capital and they mentioned some of the higher profile angels that they've got in their deal or the high profile individuals they've got in there as well. Now, what's the truth? You actually don't know how much they've invested. They could have invested 25K for all you know. And in fact, I remember looking at some capital raises and that was the case. High profile investor puts in 25K. In your mind, you're thinking they've probably invested $1 million. In reality, they may have only invested 25K, right? But this is the game. Next one, awards that they've won, any grants that they've received, especially for the technical businesses. Grants are always helpful because it obviously, especially right now, there's so many grants available for technical businesses and the actual due diligence process to get those grants is pretty thorough. So highlighting your various grants, whatever capital you can raise personally, investors often know that it's got a longer leg life than just the money that they're getting from you. And also if there's matching grant options and all that sort of stuff. So, for example, there's a matching grant where if you raise $2 million, then you get another $2 million from a grant. That's also helpful because from the investor's perspective, they're thinking about their money is going further than what it would if it was just them investing. Sector that you're in, if you're in a sector that's high growth, there's a great saying that a rising tide lifts all boats. If you want any better proof of that, just think about the AI native related businesses. You think about the money that's going to some of those companies at crazy valuations. The valuations when 2020 and 2021, the good old times for raising capital were going through, people thought, this is not going to happen again. Everyone's going to get to profitability. AI comes, buzzword, everyone goes in, valuations go ridiculous, and it's like literally just watching the same thing over and over again. So, and then any impressive metrics that you can lean into. These are your social proof statements. Now, if you're a B2B business, if you've got brand name clients in your area or partnerships or trials, they are the things that you talk to. I'm working with a lot of life science companies at the moment. I'm encouraging them to talk about the different hospitals that they're doing trials with or the different universities that they've been sort of either spun out of or that they've got relationships with. Anything that someone else would know, as soon as a brand name that someone else would know, that's why I call it capital raising brand elements because it basically when someone sees it, they instantly identify with it. Does that make sense? Haven't lost anyone yet? I know I'm speaking super fast. Yeah, absolutely. Yeah, in fact, this is upfront. Like for me, typically, I'll actually go through this. In your pitch deck, you typically have your pitch deck, and you actually have a one-page investment flyer. You assume that no one reads the pitch deck, everyone reads the one-page investment flyer, right? And you have that in there. So make sure, here's another simple thing that a lot of people don't do. Have an investor relations tab on your website. I actually learned this from one of my clients, where basically they'd raised millions of dollars from the investor relations tab on their website. And I thought, shit, and I thought, I'd been in this game for a long time and I didn't even have that. As soon as I added it, I actually had an investor come through within a month following it. Now that was in the good times of raising money in 2021, but it's a valuable thing to have because you never know who's looking at your website. Once again, that 24/7 mindset, you never know who is looking at your LinkedIn, who is looking at your website, who's at an event you're at. It's always just thinking about how can it be working for you even if you're not working on it. Yep.
What do you put into the investor relations page?
So on the basically just put in there, is a startup or a scale-up company. We're looking to have conversations with high net worth or strategic investors. Please register interest. And just have a little capture, just have a little form on it so they can register interest. Or you can put in there, you're a high, put in ChatGPT. Say, I'm building investor relations page. So I don't know what your business is. Otherwise, I'd use your example. But put in the ChatGPT, say, I want to put an investor relations page that's designed to actually attract investors to my business. Create it. Or go and have a look at the one I've got on the Wholesale Investor site. All right, so setting up your pitch deck room, right? So whether you have this in a Google Drive, whether you're using, something for your actual deal room, right? All you have is something really simple. Your pitch deck, you have a 1 to 2 page deal term or just call it investment flyer. And then the other thing is any other document that answers questions for you, right? That saves an investor asking questions. A big one for me is if you do enough capital raising. The reason I was asking was, anyone done 5+ capital raisings? If you've done anything more than 2 capital raisings, you absolutely get annoyed when the same questions get asked over and over. So there's a way to solve that. In fact, for me, I found I was spending 4 to 6 hours with investors, right? And I'll show you how I was able to get that down. So that's as a starting point. Next one, set up your frequently asked questions. Right? So you may have spoken to enough investors, or you may know what they're going to be asking you. Answer your investors' questions before they ask them. I learned this from an investment banker. What they would do is they would go on what I talked about before, the deal roadshows. And what they would do is they would basically get together at the end of each day. So when they'd finish pitching, during the actual sessions, they'd have one of their team members document the questions that were asked from the investors. Then what they would do is they would actually formally answer those questions that night. And then in that document, when they'd send their information pack through for the next day, they would then send through their frequently asked questions. So every day they would build on those frequently asked questions. So by the time they finished the deal roadshow, basically they had this great sort of deck of all the frequently asked questions that investors would ask them. But I know you're sitting there thinking, what questions should I start? So let's say you're starting the process. First, these are some simple ones that you can actually get you started. Now let's make sure some simple ones to actually get you started on creating your FAQs. Right? Firstly, how do I explain the valuation? That was my number one question in my deal room that was looked at by investors. How do I explain the valuation? What are your valuation references, or what valuation model did you use to come up with that? Because valuation is an art and science. Like I actually genuinely don't know anyone who thinks they've got the valuation process nailed, right? It is really art and science in how you do it, but you've got to give a reference for it. How does the business generate revenue? If you're pre-revenue, how do you plan to go market? These ones are some simple ones. For the non-technical businesses or the businesses that are in revenue, what are your top 3 revenue drivers? And you can even add to that, what are your top 3 growth drivers? Right? Because a simple thing is, an investor, when they're looking at your company, they want to understand where their money is going. So people have their use of funds and they articulate where their use of funds are. Your use of funds has to tie back to your top 3 growth drivers, right? Because an investor wants to understand how they're going to put money into your business and then how you're going to leverage that money to create value in the company. So what are your top 3 growth drivers, right? And by the way, this is all a game of thesis. Right? You've got your thesis about what your top 3 growth drivers are. The investors got their thesis about what they believe is going to be your 3 growth, and do they believe yours? Right? It's always a game. Now, the next one is, if you're going back to the technical businesses, your question is what are the top 3 ways what are the top 3 key technical milestones, and how do you plan to de-risk those milestones? So how will the use of funds help you get to either clinical trials, or get you the data, or get you whatever you need, or partnerships, or whatever it may be, to get you to the next stage? And when it does get you to that next stage, what is the value inflection point when you do? Right? Next one is, what is the potential exit path for investors? Funny enough, this question was taken off the table for a while until it became really difficult to get exits. And then now it's all of a sudden back on the table. But typically, what is the path for exit for investors? So what does that potentially look like? Now, as a startup, that may be super hard for you right now, but it's a question to actually think about, because at some stage, an investor wants to know how they're going to make their money back. Like, what is that actual pathway? 5 years ago, it used to be, don't think about an exit, just grow, 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 right? That's not the case anymore, because a lot of investment groups have struggled to get exits, you know, and there's that issue of the sort of ability to recycle capital, etc. And then obviously, what is your moat? What makes you different? What makes you unique? Is it IP? You know, and for software businesses, this is really hard at the moment. If you're just a software business, the biggest challenge that we've all got, anyone's built software, the biggest challenge we've got is that the value of software is going to zero, right? And we literally have all seen that before our eyes. So what is your actual moat? Is it something data related? You know, you have to figure that out for yourself. What is your actual moat? So now one other part I mentioned is that when you speak to an investor, you're having their first conversation. Typically for me, I make the first conversation 30 minutes and 30 minutes only, right? But what I do is I give them access to my deal room beforehand. In my deal room, I've got all my news that I published in that. And sometimes it's just things I've posted on LinkedIn, sometimes it's stuff I've posted on my website, sometimes it's videos I've done, etc. But the reason I do that is because I took the decision that when I went through that process of spending 4 to 6 hours with every investor, I just knew that wasn't sustainable because I still had to build a business, right? So what I did was I pulled all this together and I took the approach that I will provide the opportunity for investors in my deal room to spend as much or as little time with my information as they please. Now, the reason why it's important outside of LinkedIn is because when I'm in LinkedIn or in my inbox, how much headspace do you give something in your inbox or in your LinkedIn? Seconds. They need to go into another environment where their actual brain is ready to look at something. So for me, I've used my deal room for that. I've got my FAQs in there. I've got news flow. I've got pitch decks, etc. Because what I thought was I want them to spend 4 to 6 hours with my deal room, right? Not that they'll do that, but I want them to spend that time with my deal room answering the questions that they're likely to ask and not asking them to me. Not because I don't want to build the relationship. I'd much rather build the relationship than spend my time answering the exact same questions over and over again. All right, so next part. Simple principles. The more investors engage with you, the more you'll raise. The more you engage investors over time, the more you'll raise. Take the assumption that you never know. Like recently we've had investors come into our company and I'd never met them. I never spoke to them and I never met them, right? And this is just sheer amount of content that we actually put out. They got to know, understand the business, what we do, how we make money, all that sort of stuff was all covered in my actual information. The more you treat investors like a transaction, the less you will raise, right? And that is one of the biggest issues in this space is people get treated like a transaction, which is one of the challenges. And then plant seeds consistently. So this is the most important one. The planting of seeds. So every announcement you put out about your company, every update you put out, you've got to think about it like a seed planting activity. The only difference with this seed planting activity is you don't know when it's going to bear fruit. But you've got to take the assumption that at some stage it will bear fruit, right? So keep on planting those seeds, keep on putting out those updates and announcements. So this for me, this is inside. So when I mentioned to you about that sort of 2018 period, we actually then went and built our own software to actually manage that. And that ultimately become our product that we would offer. And so in it, I actually built in basically, you know, intelligence so I could understand what investors are doing in my raise and a scoring feature. So what I found in my own experience is that basically, this is on the FAQs. So if you have a look at this, and it's actually a whole lot more now because it's taken a while ago, but basically, how do you explain the valuation was my number one question that investors were looking at for me. This was a screenshot from my real room at the time. What are the upsells and additional opportunities and so forth? And what are we thinking about in different areas? It gave me insights into what was the most important question for investors. Down the bottom here was what was least interesting for some investors. And then I also learned there was a correlation between one question that investors would look at and then when they would become shareholders. And for me, that one was, are there other benefits to being a shareholder? That to me was actually one of my key signal questions that someone was going to be a shareholder because there was other ways that they could extract value from what we do. The next one that was interesting for me was this is when you go into the process of when an investor's interested in what you're doing. So we've got all this sort of timeline. I could actually see what they were doing before they would become an investor, right? So I found a simple thing that if someone went in to download my documents twice or have a look at my documents twice, there was a higher chance they were going to be an investor. Or if they looked at my frequently asked questions on 2 different occasions, there was a higher possibility they were going to become an investor. And then the next one was, I had a thesis, there was a correlation between the way someone would engage in a deal room and them actually becoming an investor. And I proved that with my own room, where the top 14 people in my room, out of the top 15, 14 had become shareholders. I am still yet to get that 15th one, which is annoying. So, and then the last one is why you should always be raising. This was an example of someone who basically become a shareholder. Effectively, they looked at it over a year, and you could see that just engagement over different periods of time, and then ultimately they became a shareholder, right? So I had one investor who actually said no to 2 rounds and then participated in 2 rounds, right? So I thought he was done, but no, he then actually went and participated in 2 rounds. So you just never know. And then the benefits of the right capital raising process, as I said, you go from spending 3 to 5 hours with every investor. For me now, it's between 30 to 60 minutes, right? The conversion rate can improve significantly on conversations that you have with. And then likewise, just awareness of the actual process. So just simplifying it for yourself. And by the way, the reason I'm going to send this presentation to everyone, by the way, just so you know. Okay, now the last part is, next part is what to do if you're not raising. This is always a hard one, right? Because we want to go out and say, yeah, we're going to be bullish, we're going to raise money, etc. But if you're not raising, speak to some of your friendly investors and try and get their feedback, right? Because it could be deal structure, it could be your pricing. I had it's actually a friend of mine. You know, he was going into a round, and we sort of talked about his strategy. But stupidly, I look back at it. I never asked him about what valuation he was going out with. And this was in 2023. He was trying to raise money pre-revenue on a $30 million valuation. And I was like, you know, I was like, I wish he had to mention that. And he said, oh, one thing I'm getting bite back from investors is around the valuation. Yeah, no shit. You know, and then revisit the valuation, make adjustments. It could be deal structure, and there's all sorts of flexibility that you can do with these kinds of offers. So, and then just make the adjustments, and then go back out again. The actual truth is, when it comes to raising money, you have to be shameless. You have all these psychological thoughts. You have people planting seeds in your head about, oh, this is going to look bad if you do this. Oh, don't go back out again because it'll look desperate or look, you know, at some point, like you just have to do it. Like you absolutely have to be shameless in how you go about it until you actually get that capital raised, right? Because ultimately that is the most important part. You have so many different ego conflicting factors, you know, that go through your mind about how it looks and all that. And trust me, I'm in the worst position for that because I actually run a platform for raising money and have utilized my own database to raise money. And I've had money fall over, signed application forms that didn't come through, experienced everything that everyone goes through, right? So this is why I speak on this stuff, because out of curiosity, has anyone heard anyone talk about capital raising like I am? Anyone heard that before? Right? This is the problem, right? Because no one really wants to talk about what they go through in a raise, right? Actually, probably the most honest ones who will talk about it is the life science companies, because you know it's sort of known how hard it is, you know, in raising money for life sciences. So ultimately, the process, no different to if you're a professional sports player, if you're a professional anything, analyze what you're doing, refine it, improve it, repeat. The biggest mistake we all make is when you finish your capital raising, if you think that you are done for the next 2 years, the biggest mistake I made is when Investec came into the company, I stopped raising capital. Flat out, one of the biggest mistakes I've ever made. I should have used them. I had my lead technically, if I look back now, I had my lead investor, and it would have been so much easier to go and raise more, right? So do not stop raising. And then the personal benefit goal is you want to have some sort of confidence when you go into a raise. Because the truth is, that perfect video that Elon Musk put out about, building a business is like eating glass and staring into the abyss. It's not quite that bad sort of raising capital, but staring into the abyss is, because you really don't know how it's all going to play out, but you want to have some sort of confidence that you're going to get to an outcome. So summary, how am I going for time? Am I over yet? Oh, I'm actually going to make it. Summary, set up investor-friendly content, engage investors, no different to how you do it with your market, with the selling of your product. Think about it with investors as well. Just give them the opportunity to engage. We invite them to events. We invite them to all different types of things to get additional value from what we do. Just whatever levers you have to pull them to engage. Invite investors to your deal room or to your documents. Let them stalk you on LinkedIn, right? Most important one, let them stalk what you're doing on LinkedIn. Share milestones and progress. Be consistent. I'm trying to put out something at least every 1 month to 2 months about, either sort of progress or invites to things or something, because it really is the case, out of sight, out of mind, right? That person, if you're going up to someone saying, I met you 2 years ago when I pitched my business, just be assured you are long gone from their head if they haven't seen anything else, right? So, yeah. So I'll just give a little short demo of what we've done from our software side. So this is what I built when I got really frustrated. And then what I kept on doing is I kept on building all the features that I built into it was actually while I was going through all my frustrations of raising capital. I was in a unique position where I could take all the things I was annoyed about and put it into my product. So we do have a free version of the software. Obviously there's a paid version, but we do have a free for lifetime version of the actual software where you can run your capital raises through, etc. Our paid version just means you can access our investors and we actually promote you. But the free version means you can run your own sort of process and use it. I strongly recommend to actually use something like a deal room to do it, because as I said, there's a big difference between email headspace, LinkedIn headspace, and when someone actually goes into your deal room to go and look at content. So feel free to scan that. I said I'll send it out afterwards. You're all welcome to set up a free account. It goes to a page. Just choose the free option and you'll be able to set up a version of it. And one of my team can assist you with the setup of the room if you need it. And then upcoming stuff, just as a high level, some of the stuff that we're doing. We do have an AI summit coming up in, 2.5 weeks? So basically, for me, I'm absolutely nuts about AI. So, I'm sure all of you are. I think, anyone that's been through this last 3 years, you should be all over it. But effectively, what I want to do is just have founders and have business owners have a playbook for how to 5x and 10x, both what they're doing and also what their team are doing. There's two things around that. Obviously, you can go as an attendee, but if you're an AI-based company and you think it could be relevant to present, there's also that sort of potential opportunity. There is a fee for that one, just to let you know, but there is a small entry fee for the coming along as an attendee, but not much compared to what we're giving from a value perspective. If you've got ambitions for India, we're doing our first conference in India in December 2. And then likewise, if you're a life science medtech company, we're actually partnering with MTP Connect to do a life science investor day on Feb 18th at our Emergence conference, Feb 19th and 20th. This year, I've called the conference Abundance and Convergence. So it's all focused around the thematics of the convergence of all the technology platforms, and then the creation of abundance that actually is going to go along with it. So I said, I'm super bullish about, this last 3 years has been incredibly punishing for all founders, like absolutely the hardest period that I've ever experienced in my 16 years for raising money, doing, all sorts of things. But, I'm very bullish because I can see what AI has done for me personally. I can see what it's done for my team. And now that all the different LLMs are rolling out their own version of browsers, AI agents, etc., I'm even more bullish about what one person can do and how much can be created from a productivity and a revenue standpoint, etc. So, that is it from me. Oh, final parts I'll mention. Set up small stuff to make it easier for yourself. you can set up a free account, apollo.io. I've set up all sorts of templates, snippets, sequences, etc. Just because we ultimately end up sending out the same emails over and over again. No point typing it out. My new favorite tool that I absolutely love is Whisperflow. I'm a slow typer. I type between like 30 to 40 words per minute on good days. Now with Whisperflow, it's up to 130 to 140 words per minute. Best AI dictation tool I have ever used in my life. Strongly recommend it for everyone. There's nothing like just hitting a button, talking away, and watching emails be perfectly structured, grammar perfectly done. Obviously integrate Grammarly as well. And then Calendly. Nothing saves time like having people just book meetings in your calendar. Typically what I do in mine, so I basically have a little bit of an intro as well, and I actually include a couple videos. And then so what people do is they watch those videos before they have a conversation with me. So then it provides a great foundation for the conversation I'm about to have. That all come from, I went through one of the hardest periods of my life at the end of 2022 and in 2023. And I had to figure out how to make myself the most humanly efficient possible person that I could be. And so, these are just some of the things, but, things like that made a massive difference, in that actual process. So that is it from me. Happy to do Q&A. If you want to add me on LinkedIn, feel free to. If you want to ask questions, go for it. 2 minutes over. That's almost a record for me. I know, it's a record for me. My team always gets upset that I go over. Does anyone have any questions?
Quick question.
Yep.
Averages and medians mean absolutely nothing in numbers, but what would be the most common amount of an investment into a business like yours, like ours?
So typically I find with private high net worths, typically they invest, and angels can be slightly different because they can be under, but private high net worths is typically 25K to 250K. I find family offices, it can really range, but typically 500K and above. Sometimes they may put 200, if they like you, but they still have doubts, it could be 100 and 200K, but typically 500K and above. And then investment groups will have their mandates that are publicly stated about what they invest. But the main one is with high net worths, it's typically between sort of 25 to 250K.
I just seem like there's that magic doctor number of 50.
The hardest, I suppose the other question you're leading to is what minimum should I have? If you're going out with a capital raise, what minimum should I have on it? I find 50 is good, right? Because if someone wants to put in 25, they'll tell you they've only got 25 to put in, and you can make the decision whether you want to accept it or not. And then typically people will go for the minimum. So it's a good enough amount to come in. I'd say typically 50 is often a good minimum.
I have my question.
Yes. I can't believe you got a question.
Let me word this in the right way. What terminology should founders kind of familiarize themselves with when capital raising?
Capital engagement.
Capital engagement?
I'd actually get rid of the words capital raise. Like there's probably heaps of terminology, but I would say if you change the word raising to engagement, and it changes the entire way you think about the process, right? So what sort of things would you like to know from a terms perspective?
I was more thinking like cap tables and like that more technical terminology.
Cap tables, pricing of the round.
Yeah.
There's heaps.
Yeah,
there's
I think
heaps.
where I'm going with that is there's so much content out there with
Yeah.
capital raising. How do you know what's the most relevant and what's the most accurate and stuff like that?
Yeah.
Just because there's so much out there.
I think what becomes relevant is your strategy. So if you're doing a priced round, where you're doing it as equity, then effectively all the things are going to be, and you, once again, just go to your favorite LLM. If I'm going to be doing an equity capital raise, what's all the most relevant terminology I should be thinking about? And then the other one is if you're going to be doing a convertible note. Convertible note's a little bit of a trickier one because there is actually a bunch of different ways you can do it. And I only found this out through experience through investors. So with convertible notes, it's effectively, basically someone's investing into your company on the basis that, and you've got all sorts of different structures. So I'll ask things like, what's the convertible note term? Is it 1 year? Is it 2 years? What's going to be the coupon rate, which is what's going to be the interest that they're going to receive? Is it, then you've got options around, are you going to force the investor to convert, or do they have the option to get their money back? That's also another aspect. So, once again, go to your favorite LLM. What things should I know? If I'm doing a convertible note raise, what's some of the key terminology that I should know? But yeah, that'd probably be the two different pathways, or whether it be a convertible note, or whether it be an equity raise. Yep.
If you're getting equity for investors, say 25K, isn't it risky to end up with too many investors? And how do you manage?
Absolutely. Do you know how? This is how all conversations start out. I want as few investors as possible. I want to raise $2 million. I want it from 1 to 2 investors. You do that. Don't raise. I want to get, and it just proceeds down from there, right? So absolutely it is. The reality is the way, I said, there's different games for different, if your business is scaling at an incredible rate, you're going to have offers. You're going to have term sheets being offered to you. You'll have investors interested in what you're doing, etc. Right? If you're not doing that, there's still options, but you just got to understand that it may look different to what you'd imagine to start with. So the ways you can facilitate that is you can create up SPVs, which is special purpose vehicles, right? Which is just basically another company entity that can have multiple shareholders in it. Right? People typically do it as, bare, now you're going to the terminology. They typically do it as bare trusts, right? In the structure part, but it just means you can have multiple investors. And just so you know, what he's referencing is that, people are often worried about managing a lot of shareholders. Managing a lot of shareholders, yes, it can be challenging at times, but it's actually on the most, it's actually not that bad, right? If you're communicating a lot. If you're communicating frequently, it's often not that bad. Some investors will be passive. They'll just read what you're doing and you won't hear from them too much. Others will be active and refer people to you or want more conversations with you. It's just the nature of the beast, but just communicate a lot.
Can I ask, do you have like a particular, all this paperwork and, bare trust and all, is there a particular solicitor firms who specialize or the ones you use here in Sydney?
I had a lawyer do it for me. I'm just trying to think. Maybe Sprint Law would have them. Yeah, there's a bunch of different legal tech providers that have probably got options. Yeah. Pardon? Yeah, LawPath would probably have. There's probably a few. Like if I was being a startup again, I would probably go down one of those. So I'd go and look at 3 to 5 of those different solutions and see what they had. Yeah, Sprint Law, LawPath. There's a couple of them. I just can't remember their names.
Rather use the one you use since they're tested.
I saw a question at the back.
Hi, sorry, this is not really about capital raising, but more about the Capital HQ platform.
Yeah.
And also the event. So I was just wondering, because I'm pre-MVP, can I still access the Capital HQ platform, or
Yeah.
is it like a certain kind of stage you have to be at to access
No.
it?
Not for the free version, no.
Okay. And also kind of same thing. So my startup is in the AI space. So I was just wondering, once again, because I'm pre-MVP, can I still have the opportunity to present? And
So with that, I'd encourage no. And the only reason is because we charge for what we do, and what we charge you should be putting into your product.
Okay, cool. That's it.
So we're better when there's sort of some milestones, some revenue, etc. Except for if you're a life science technical, a whole different game. Like there's different things we look for, but yeah.
That's it. Thank you.
No problems.
Do you have term sheet templates in your website?
No. But once again, all this stuff, you can
You can go on that.
correct. Yeah. That's a beautiful thing about AI. No one has any special real secret sauce anymore, you know? Yes?
This is more like a question on the fundraising. So you mentioned that 2022 was really good and then a lot of fundraising.
No, 2021 and the first 3 months of 2022 were not pretty good, amazing. After that, all pain.
Right. So what's the advice for founders who have raised at a higher price and realize that they probably need to do a down round longer term? Like how does your platform actually help with that?
Oh no, platforms don't help with that. That's in strategy, right? Like so typically if you got to do a down round, or if you basically haven't sort of been able to hit the milestones, there is flexibility in what you can do. Yes, you can just do a down round and eat it, like what you saw with Klarna. Klarna had the best example. They just did a 90% down round, raised the money, and now they're sort of back. They're back swinging again. The other ways is, often if you notice, pretty much for the last sort of 2 to 3 years, everyone's been doing bridging rounds, right? Bridging round is typically a convertible note round. So often convertible notes are used in the process. So it allows you to basically keep the valuation that you raised that last time, but effectively, like as far as a hard cap on the actual, once again, that's another term that you were asking about, like a hard cap in a convertible note. You often will have a discount to the convertible note hard cap of anywhere between sort of 15 to 30%. And that sort of helps an investor understand sort of where you're thinking about pricing it. I did add something where I had a favored nation clause in it. So if I raise under the hard cap that I'd set, that investor would still get a discount on that valuation, the lower valuation. Like unfortunately, like when it's hard to raise money, if you're not a ridiculously high scaling AI company, you do have to, it's an investor's, put it this way, it's an investor's market right now. In 2020, 2021, founder's market. Yep.
What do you think of safe notes?
Yeah, it's an interesting one. Like obviously they get talked about a lot. I haven't seen it used too successfully. I know people have done them, but to be blunt, I don't see them as being that much different to a convertible note, except for obviously the sort of, there is slightly different terms in how it's structured. I'm not sure what the perception of investors is around them at the moment, but really a safe note's no different to a convertible note. Is you're just trying to delay the pricing of the capital raise or the valuation conversation. Anyone else? All right, ladies and gentlemen, we are done. Feel free to add me on LinkedIn. We'll send out an email with the presentation. Obviously, we'll give a link to it. Hope you enjoyed the session. I hope you got value from it. Enjoy.